Welcome to Investing for Beginners in 2026. Understanding investments is crucial for your financial future. Let's explore how to grow your wealth. This video will guide you through fundamental concepts, strategies, and practical steps. Get ready to build a stronger financial foundation. I'm Master William, your guide to navigating the exciting world of investing. Let's demystify finance together and empower your decisions. First, what is investing? It's allocating resources, usually money, with the expectation of generating income or profit. It's different from saving. Saving means setting aside money for future use, often in a bank account. Investing means putting your money to work, aiming for growth. Let's define key terms. Assets are things you own that have value, like property or stocks. Liabilities are what you owe, such as loans. Capital is the money or assets used to start an investment. Returns are the profit or income generated from your investment over time. Risk is the potential for loss or gain. Diversification means spreading investments across various assets to reduce overall risk. Don't put all your eggs in one basket. Now, the magic of compound interest. It's earning returns on your initial investment and on the accumulated interest from previous periods. Even small, consistent investments can grow significantly over time thanks to compounding. Start early to maximize this powerful effect. Before investing, define your financial goals. Are you saving for retirement, a home, or education? Clear goals guide your strategy. Distinguish between short-term and long-term objectives. Short-term goals might be achieved in a few years, while long-term goals span decades. Crucially, build an emergency fund before investing. This safety net covers unexpected expenses, preventing you from needing to sell investments prematurely. Now, let's explore different types of investments. First, stocks. When you buy a stock, you're buying a small piece of ownership in a company. Stocks work by buying low and selling high, or through dividends, which are portions of the company's profits paid to shareholders. Stocks offer potential for high returns but come with higher volatility. Their value can fluctuate significantly based on market conditions. Next, bonds. When you buy a bond, you're essentially lending money to a government or corporation. They pay you interest over a set period. Government bonds are generally safer but offer lower returns. Corporate bonds carry more risk but can provide higher interest payments. Bonds offer lower risk and steady income, making them a stable component of a diversified portfolio. However, their returns are typically lower than stocks. Mutual funds and ETFs, exchange-traded funds, offer diversification and professional management. They pool money from many investors. You can choose funds based on your objectives and risk tolerance. They provide instant diversification across many stocks or bonds. Real estate is another investment option. This includes direct ownership of property or investing in real estate investment trusts, or REITs. Real estate offers tangible assets and potential rental income. However, it can be illiquid and requires significant capital up front. Finally, alternative investments like cryptocurrencies and commodities. These can offer high returns, but come with significantly higher volatility and risk. Now, let's discuss investment strategies for 2026. Diversification is key. Don't put all your eggs in one basket. Spread your investments across different asset classes, industries, and geographies to mitigate risk. This protects your portfolio from downturns. Dollar cost averaging involves investing a fixed amount regularly, regardless of market fluctuations. This strategy mitigates market timing risk. Emphasize a long-term perspective. Market ups and downs are normal. Patience and consistency are your greatest allies in investing. For 2026, stay informed about current market trends and economic indicators. Geopolitical events and technological advancements can impact markets. Understanding these factors helps you make informed decisions. But remember, don't react impulsively to every news cycle. Managing risk and volatility is crucial. Identify common investment risks like market risk, inflation risk, and interest rate risk. Strategies for mitigating risk include asset allocation and rebalancing your portfolio periodically to maintain your desired risk level. The importance of emotional discipline during market fluctuations cannot be overstated. Avoid panic selling or chasing hot trends. Ready to get started? Practical steps include opening a brokerage account. Choose a reputable platform that suits your needs. Research investment options thoroughly. Understand what you're investing in before committing your capital. Knowledge is power. Start small and consistently contribute. Even modest, Regular contributions can build substantial wealth over the long term. To recap, we've covered fundamental concepts, types of investments, strategies for 2026, and managing risk. Your financial journey starts now. Continue learning, stay patient, and be disciplined. The path to financial growth is a marathon, not a sprint. You've got this. Start investing today, and don't hesitate to seek professional advice if needed. Empower your financial future. Thank you for watching.